The greatest heist in human history has already happened. It didn't happen with guns or masks or a getaway car. It happened with a pen. It happened in quiet committee rooms in 1994, buried in thousands of pages of legal code that no ordinary citizen would ever read. And right now, as you watch this video, the trap that was set 30 years ago is waiting to snap shut. If you have a 401k, an IRA, or a brokerage account on Robinhood, Fidelity, or Vanguard, you believe something that is fundamentally false. You believe you own your stocks. You believe that if you bought 100 shares of Apple, those shares belong to you, that they are your property, that no matter what happens to the bank, or the broker, or the economy, those shares are yours to keep. I am here to tell you that you are wrong. Legally, technically, and contractually, you own nothing. You do not own the shares. You do not have property rights. What you have is a security entitlement. It sounds like a technicality, a boring legal distinction. But in a court of law, it is the difference between being an owner and being an unsecured creditor. And in the next financial crisis, the one projected for 2026, that distinction will mean the difference between keeping your life savings and losing absolutely everything. This is not a conspiracy theory. This is the black and white letter of the law. It is enshrined in the Uniform Commercial Code, Article 8. And it is the legal framework for what former hedge fund manager David Rogers Webb calls the Great Taking. A mechanism designed to legally confiscate the collateral of the entire global financial system, stocks, bonds, and pensions, and hand it over to the protected class of megabanks. To understand how this heist works, we have to peel back the curtain on the most powerful company in the world. A company you have probably never heard of. It isn't BlackRock. It isn't Vanguard. It isn't even the Federal Reserve. It is a private corporation located at 55 Water Street in New York City. Its name is Cede Co, spelled C-E-D-E. If you look at the official ledger of the United States stock market, you will find something terrifying. You are not listed as the owner of your Apple stock. Neither is your neighbor. Neither is your pension fund. Cede Co is the listed owner of 99% of all publicly traded stock in the United States. It owns $34 trillion in assets. When you buy a stock on your phone, you are not buying a digital certificate that has your name on it. You are buying a contractual right to a share that is held by your broker, which is held by a custodian, which is ultimately held by Cede Co. It is a chain of custody, and you are at the very bottom of that chain. Why does this matter? Why should you care who technically owns the stock as long as you get the profits? Because of what happens in a bankruptcy. In 1994, the laws of ownership were rewritten. Before 1994, if your stockbroker went bankrupt, the liquidator could not touch your stocks. They were your property. They were segregated. If the broker burned down, your stocks were safe in a vault with your name on them. But the 1994 revision to the Uniform Commercial Code changed you from an owner into a security entitlement holder. It pooled all the assets together. Now, your assets are considered part of the broker's general pool of capital. And this brings us to the villain of the story, the super priority creditor. You see, your broker uses your stocks as collateral. They use your portfolio to borrow money to do their own trading. This is called rehypothecation. They take the Apple stock you think you own, and they pledge it as collateral for their own massive derivatives bets. They are gambling with your life savings. And who are they gambling with? The too big to fail banks, JP Morgan, Goldman Sachs, the clearinghouses. These giant banks are the secured creditors. They have a special legal status called super priority. Here's the nightmare scenario. It is 2026. The markets crash. Your brokerage firm, let's call them Broker X, made some bad bets on derivatives. They are insolvent. They file for bankruptcy. In the old days, you would just transfer your stocks to a new broker. But under the current law, Broker X owes billions to the secured creditors, the big banks. Because your stocks are now pooled collateral, the big banks have the legal right to seize your assets to pay off the broker's debt. They get paid first, you get paid last. It is a legalized theft, a bail-in of the entire securities market. The law explicitly states that secured creditors have priority over entitlement holders. That means JP Morgan takes your Apple stock. You get a claim in bankruptcy court for pennies on the dollar. You might think, that's impossible. The SIPC insurance protects me up to $500,000. We will get to the SIPC lie in a moment, but let me tell you this. The SIPC has about $4 billion in its reserve fund. The U.S. stock market is worth $50 trillion. If the system collapses, the insurance fund is a drop of water in a forest fire. It is mathematically impossible for them to bail everyone out. This system was not built by accident. It was built by design. It creates a trap door under the economy. For the last 30 years, they have been moving everyone into this pooled system. They eliminated paper certificates. They pushed everyone onto digital apps. They made it frictionless to buy, but impossible to own. They turned the entire population into tenants of the financial system. And just like a landlord can evict a tenant, the system can evict you from your wealth. So how did this happen? Who signed this law? And most importantly, what is the trigger event that allows them to execute the seizure? To understand that, we have to look at the derivatives bubble, the quadrillion-dollar time bomb that is ticking underneath the surface. This is the excuse they will use to take everything. To understand why they changed the law to steal your assets, you first have to understand why they need them. They don't want your stocks because they like Apple or Microsoft. They need your stocks because they are the only real collateral left to back up their gambling addiction. This gambling addiction has a name: derivatives. Most people think the stock market is the biggest market in the world. It isn't. It is a dwarf. The global stock market is worth about $110 trillion. The global derivatives market is estimated at over $1 quadrillion. That is a 1 with 15 zeros behind it. It is 10 times larger than the entire global economy. So what is a derivative? It is a bet, nothing more. Banks bet on interest rates going up. They bet on currency values going down. They bet on the price of oil. JP Morgan, Goldman Sachs, and Deutsche Bank have trillions of dollars of these bets on their books. In a normal market, these bets cancel each other out. But in a crisis, like the one coming in 2026, the volatility explodes. Suddenly, a bank finds itself on the losing side of a $50 trillion bet. They don't have the cash to pay it. Nobody has that much cash. So they need collateral to cover the margin call. And this is where you come in. Remember the pooled collateral we talked about at the start of this video? Because you are a security entitlement holder and not an owner, your stocks are sitting in the same pool as the bank's derivatives bets. When the crash happens, the secured creditors, the ones holding the winning side of the derivative bet, have a legal claim to the entire pool. They sweep the accounts. This brings us to the Bankruptcy Act of 2005. Before 2005, if a bank went bust, a judge would freeze everything. He would say, wait a minute, let's see who owns what before we pay anyone. But the big banks lobbied Congress to change the law. They inserted a safe harbor provision for derivatives. This law says that derivatives are exempt from the automatic stay in bankruptcy. This means they don't have to wait for the judge. They don't have to wait for the bankruptcy proceedings. They can seize the collateral immediately, instantly. Imagine this scenario in 2026. It is a Tuesday morning. The market crashes 20% due to the tariff shock. A major clearinghouse, like the DTCC, is technically insolvent because of bad bets. At 9 a.m., they declare insolvency. At 9:01 a.m., the secured creditors, JP Morgan, Bank of America, trigger the safe harbor provision. They electronically seize the trillions of dollars in stocks and bonds held in the DTCC pool to cover their debts. By 9:05 a.m., the assets are gone. Transfer complete. At 10 a.m., the bankruptcy judge arrives. He looks at the books. The cupboard is bare. The collateral is gone. The stocks are gone. The bonds are gone. And then at 11 a.m., you try to log into your brokerage account. You see a message, account suspended, institution in liquidation. You call customer service, no answer. You think, it's okay, I have insurance, I own those shares. But you are about to learn the hard truth. You are an unsecured creditor. You have a claim against the broker, but the broker has no assets left. The secured creditors took them all at 9:01 a.m. This is the great taking. It is the authorized transfer of wealth from the people to the systemically important banks. And it is perfectly legal. But surely the government wouldn't let this happen. Surely they would step in. They will step in, but not to save you. They will step in to save the system. Financial expert Jim Rickards calls this Ice 9. It is a reference to a fictional material that freezes all water it touches. In the financial world, Ice 9 is a total system freeze. When the panic starts, they won't just let the banks fail. They will close the exchanges. They will order a bank holiday. You won't be able to sell. You won't be able to withdraw. They will freeze the system to restore order. And while the system is frozen, the restructuring happens behind closed doors. They will decide who gets bailed out and who gets bailed in. And history tells us the answer. Bondholders and derivatives counterparties are protected. They are systemic. Depositors and 401k holders are not. They are liquidity. This happened in 1933. This happened in Cyprus in 2013. And the laws passed in 1994 and 2005 ensure it will happen here in 2026. You are sitting on a trap door. And the lever is in the hands of the very people who created the debt bubble. So, is there any way out? Can you own assets that cannot be legally seized? The answer is yes, but you have to move your wealth off the grid. You have to move from security entitlements to personal property. We have established the trap. The law is rigged. The banks have super priority, and the derivatives bubble is the trigger. If you stay inside the standard financial system, brokerages, banks, 401ks, you are a sitting duck. The only way to survive the great taking is to remove counterparty risk. You must move from holding claims on wealth to holding actual wealth. You must become a legal owner again, not just an entitlement holder. There are 3 main escape hatches, but the window to use them is closing fast. Escape hatch number 1, the direct registration system, or DRS. If you absolutely want to own stocks, say you believe in the long-term value of a company like Coca-Cola, you don't have to hold it at a broker. You can take your shares out of the street name system held by Cede Co. You can register them directly on the books of the company itself through a transfer agent like ComputerShare. When you do this, the shares are removed from the DTCC pool. Your name goes on the official register. You become a legal owner. If your original broker goes bankrupt, it doesn't matter. Your shares aren't there anymore. The secured creditors cannot seize assets that are directly registered in your name. The downside, it is harder to sell quickly. You can't just day trade on your phone. But for long-term holdings that you want to protect from systemic collapse, DRS is the only digital firewall. But even DRS shares are still inside the electronic grid. If the power goes out, or the internet is shut down in an ICE 9 scenario, you can't access them. The ultimate protection is to hold assets that exist outside the digital system entirely. Escape hatch number 2, physical precious metals, gold and silver. Notice I said physical. Do not buy a gold ETF like GLD. Do not buy unallocated gold in a bank vault. Those are just security entitlements again. If the custodian fails, your paper gold is gone. You must hold it in your hand. If you can't hold it, you don't own it. Gold is wealth that does not rely on anyone else's promise to pay. It has no counterparty risk. In a world of digital confiscation and bail-ins, physical gold is financial freedom. And don't forget silver. It is the money of the people for daily transactions. In a cash ban scenario, silver coins become the underground currency. It is private. It is untraceable. It is the ultimate hedge against the surveillance state. Finally, for the digital age, there's a third escape hatch. Escape hatch number 3, self-custody Bitcoin. But you must understand the golden rule of crypto. Not your keys, not your coins. If you leave your Bitcoin on an exchange like Coinbase or Binance, you have learned nothing from this video. Bitcoin on an exchange is just a crypto entitlement. You are an unsecured creditor of that exchange. We saw this happen with FTX. We saw it with Celsius. Millions of people lost everything overnight. In the 2026 crisis, the regulators will freeze the crypto exchanges first. You must take your Bitcoin off the exchange and onto a hardware wallet. When you hold your own private keys, you are your own bank. No one can seize it. No one can freeze it. The great taking is coming. The legal framework is set. The trigger is ready. The majority of people will do nothing. They will trust the system until the very moment it betrays them. They will wake up one morning to find their accounts frozen and their life savings gone. Don't be one of them. Move from renter to owner. Move from digital promises to physical reality. Secure your assets now while the exit doors are still open.